Welcome to Wealth Hustle 247 podcast, your trusted guide to financial literacy, business innovation, and entrepreneurial success. Learn how to grow your wealth, make informed decisions, and turn your ideas into profitable ventures.
Are you wasting your money picking the wrong stocks? Or is there a smarter, simpler way to grow your wealth? Today, we're breaking down index funds versus individual stocks, the hidden truth that most investors don't talk about. I'll show you which one could actually make you more money and which one could quietly drain your wallet. Stick around, because by the end, you'll know exactly where to put your money and why. Let's dive in.
If you are an active learner, someone who is always trying to optimize your decisions, you have inevitably run into the ultimate financial showdown.
Oh, absolutely. The big one.
Yeah, it's basically the heavyweight championship of wealth building.
Yeah.
Index funds versus individual stocks.
Right.
And deciding which path is actually right for you, well, it can feel incredibly overwhelming.
Because everyone has an opinion.
Exactly. If you spend even like 5 minutes on financial forums or watching market commentary, everyone seems to have a very loud, very absolute opinion about it.
And usually a very biased opinion.
Right. Yeah. But today, we're going completely noise-free. We're drawing from a comprehensive 40-plus year perspective from a business and financial intelligence practice.
Decades of data.
Decades of hard data, behavioral observation, and honestly, brutal market reality. And we are distilling it down to the absolute essentials.
Because that's what you actually need.
Exactly. The mission of this deep dive is to finally demystify this showdown for you. Not with hype, but with history and math.
I love that.
Okay, let's unpack this. Because the core thesis we are looking at today totally flips the script on how most ambitious people view investing.
It really does. Because typically, when you hear smart people argue about this topic, the conversation is almost entirely focused on trying to prove which method is mathematically superior in a vacuum.
Right, like a sterile lab experiment.
Exactly. People want to know which one yields the highest percentage return, but looking at this 40-year perspective, that approach is completely dismissed.
It's thrown out entirely.
Thrown out. It states, point blank, that most investors do not fail because they lack intelligence or because they picked the mathematically wrong vehicle.
Then why do they fail?
They fail because they fundamentally misunderstand risk, discipline, and structure. What's fascinating here is that the foundation of this entire debate isn't actually about which investment is objectively better.
It's not a simple A is better than B.
No, not at all. Instead, it frames the decision as a highly personalized matching game.
A matching game.
Yeah. It is about matching the investment strategy to your specific experience level, your emotional discipline, your actual time availability, your financial goals, and your true tolerance for risk.
I really appreciate that framing, honestly. It takes the pressure off. You don't have to pretend to be a Wall Street insider. You just have to be brutally honest with yourself.
Which is harder than it sounds.
Yeah, true. So let's bypass the elementary stuff. Since you, the listener, already know the basic mechanics of what an index fund is versus an individual stock, we aren't going to use the tired old putting eggs in a basket analogies.
Please, no more baskets.
Let's use a grocery store analogy instead. Imagine you're buying groceries. Buying an index fund is like buying the entire grocery store. You own a tiny fraction of the produce, the bakery, the canned goods. If one brand of cereal gets recalled, you don't even notice because you own thousands of other items.
Right.
But buying an individual stock is like walking into that same store, ignoring everything else, and betting your entire life savings on one specific brand of cereal.
That is a much better way to look at it, because this document frames the battle precisely as concentration risk versus volatility drag.
Okay, break that down for us.
If you go all in on one single tech giant, you aren't just taking on the broader risk of the economy. You are taking on highly concentrated risk. In the financial world, we call that idiosyncratic risk.
Idiosyncratic risk.
Yes. It's the risk associated with one specific company rather than the market as a whole. When you buy a broad index fund, your risks are macroeconomic.
Like what exactly?
You are exposed to market-wide downturns, recessions, changing interest rates, things that affect everyone.
So your risk is spread out.
Exactly. Or if you buy a single stock, you are concentrating your exposure. You are taking on bankruptcy risk, industry disruption, competitive pressure, and the big one management mistakes.
But wait, let me push back on that for a second. Let's play devil's advocate here.
Sure.
Isn't the downside of buying the entire index that you are intentionally buying the losers too?
Well, yes.
I mean, you are buying the zombie companies that are just dragging down the S&P 500. If I am an intelligent investor, why would I want to accept average returns when I could just research and pick the winners?
It is a fair question, and honestly, it's the exact reason individual stocks are so tempting. But it ignores how ruthless and unpredictable idiosyncratic risk really is.
Unpredictable being the key word there.
Totally. When you concentrate your portfolio into a few hand-picked companies, you are assuming you have better foresight than the collective global market.
Which is a bold assumption.
Very bold. You might have researched a company perfectly, you read the balance sheets, you know the product,
Mhm.
but you have absolutely no control over human error.
Right.
A CEO might make a disastrous acquisition out of nowhere. An accounting scandal could break overnight. Or just look at historical industry disruption. Think about the dominant companies during the dot-com bubble or a giant like Blockbuster Video.
Oh, wow. Yeah, Blockbuster.
People who held those individual stocks thought they were holding the future, and they had the balance sheets to prove it at the time.
They were the undisputed champions of their industry.
Exactly. But a sudden technological shift permanently wiped out their portfolios. An index fund, meanwhile, is inherently self-cleansing.
Self-cleansing, I like that term. Meaning it naturally drops the companies that are failing and automatically includes the new innovators.
Precisely. If a company in the index fails, it literally falls out of the index. And its impact on your total portfolio is negligible because it was just a tiny fraction of your holdings to begin with.
And then the index just replaces it with the next growing company.
Exactly. When you concentrate your risk in a single stock, there is no self-cleansing. If the company goes bankrupt, your investment goes to zero. You are vulnerable to highly specific, completely uncontrollable events.
Here's where it gets really interesting because the source material doesn't just look at the financial mechanics of this. It dives deep into what it calls the psychological trap of individual stocks.
Oh, this part is crucial.
It notes that stock picking feels incredibly exciting, but that excitement is heavily ego-driven. And if you think about human nature, that makes perfect sense. When you pick a single stock and it outperforms the market, you feel like an absolute genius.
You get a massive dopamine hit.
Exactly. You feel like you outsmarted the system. But wealth building, according to decades of data, favors discipline over excitement.
It is a fundamental truth that ambitious people often struggle with. You have to separate your psychological need for entertainment and ego validation from your actual wealth building strategy.
It's hard to do.
It is, but investing should be boring. If it is thrilling, you are probably doing something wrong.
That's a great rule of thumb.
And this directly ties into the hidden costs of these two approaches. We aren't just talking about money here. We are talking about the literal toll this takes on your time and your emotional bandwidth.
The emotional stress.
Exactly. Index investing requires almost zero monitoring. You set your allocation and you largely ignore it. Stock investing requires relentless, ongoing analysis.
It's a part-time job.
It really is. You have to monitor the executives, parse through quarterly earnings reports, and constantly evaluate the competitive landscape.
And what happens when the competitive landscape shifts? Let's say I own a single stock, and they report a terrible quarter due to a management mistake. The stock drops 20% in a single afternoon.
A very common scenario.
The emotional stress of that is immense. Now I have to decide, do I hold? Do I sell and cut my losses? Do I buy the dip? And I have to make that incredibly consequential decision under intense emotional duress.
While you're panicking.
Right. Contrast that with owning the broader market. A bad earnings call from one company doesn't ruin your week. You sleep better.
You definitely sleep better. And beyond the emotional stress, there is a literal structural cost difference that often goes completely ignored by retail investors.
Let's hear it.
The tax drag and trading friction.
Yes, let's dig into the tax inefficiencies. Because I think a lot of people gloss over this when they're looking at their portfolio's performance on paper.
It is a silent killer of wealth. Let's say you are a relatively good stock picker. You buy a company, it goes up 40% over 2 years, and you decide to sell it to take your profits.
Makes sense.
And you want to move that money into a new, undervalued company you just found. On paper, you made a great trade.
Right.
But in reality, outside of a tax-advantaged retirement account, you just triggered a taxable event. You now have to pay capital gains taxes on that profit, which could be a 15 or 20% haircut right off the top.
Wow. So the actual pool of money you have to invest in your next great idea is significantly smaller than the paper value of your portfolio led you to believe.
Exactly. And every time you buy or sell, a single stock trying to chase that excitement, react to volatility, or rebalance your concentrated bets, you are triggering fees and taxes that eat away at your actual returns.
It adds up fast.
Over a 30-year horizon, that tax drag is devastating to the mathematical power of compounding. An index fund, by contrast, is structurally incredibly tax efficient.
Because it just sits there.
Right. Because the fund itself rarely sells, it just holds the broad market. It generates very few taxable events.
Yeah.
Your capital is allowed to grow and compound completely uninterrupted by tax friction.
Which brings us perfectly to the core mathematical argument of this entire perspective, the compounding effect over a long horizon.
The most important concept in investing.
Now, the data acknowledges that individual stocks absolutely can, and sometimes do, outperform index funds.
Sure.
That is why they are so alluring. But to achieve that outperformance over a 30-year period requires correct selection, perfect timing, relentless emotional discipline, and flawless consistency.
And the reality is human beings simply cannot sustain that level of perfection over 3 decades. There is a quote from the source material that perfectly encapsulates this. It states, "Time is more powerful than brilliance."
Time is more powerful than brilliance. I want everyone to just let that sink in for a second.
If we connect this to the bigger picture, that single sentence is the ultimate antidote to the ego-driven psychological trap we discussed earlier.
So,
You do not need to be a brilliant stock picker who constantly finds the needle in the haystack. You just need to buy the entire haystack and let time do the heavy lifting.
by the haystack.
Yeah. Compounding works best when it is entirely uninterrupted. Consistent average returns, the kind generated by a broad index fund compound quietly and powerfully over decades.
Just a steady uphill climb.
Exactly. Eventually, that boring, steady line overtakes the portfolio of an active investor who occasionally hits a spectacular home run, but also frequently strikes out and suffers from tax drag.
And speaking of striking out, we have to talk about the ugly reality of market crashes.
We do.
Because they are a feature of the market, not a bug. They're inevitable. We saw it in 2008. We saw it in 2020. When a major crash happens, the panic is palpable.
Everyone feels it.
But how these two distinct approaches weather the storm is profoundly different. The history shows that index funds typically recover with the market. When the broader global economy eventually bounces back, the index bounces back. But the harsh reality for individual stocks, the text warns, quite ominously actually, that some individual stocks simply never recover.
This is the ultimate realization of the bankruptcy risk we talked about. It is called survivorship bias. We look back at companies like Amazon or Apple surviving the dot-com crash and assume our chosen stock will do the exact same thing.
We just assume they'll bounce back.
But a severe market-wide recession might push a slightly vulnerable single company completely into insolvency. While the overall index will eventually recover its losses and reach new all-time highs, the capital you invested in that specific failed company goes to zero.
Zero.
It stays at zero. And it is precisely this vulnerability during stressful market periods that drives investors to make catastrophic, wealth-destroying errors.
I'm glad you brought up errors, because the 40-year perspective provides a very specific list of common mistakes that derail investors.
Let's go through them.
And I guarantee, if you have been investing for any length of time, you've either made one of these mistakes or been deeply tempted to. Let's run through them. First is overconcentration.
Right, which we have covered. Putting too much of your net worth into a single company or a single sector, exposing yourself to fatal idiosyncratic risk.
Second is chasing hype.
This is buying what is trendy on social media or in the news instead of what is fundamentally sound. It is letting the fear of missing out dictate your capital allocation.
Which means buying high.
It usually means you are buying at the absolute peak of the market.
Third is panic selling. And I want to pause here because it is easy to say just hold when the market is up.
Oh, very easy.
But when your single stock is down 60% in a month, the psychological pressure to sell just to stop the bleeding is overwhelming.
It is overwhelming because the asset you hold is fundamentally fragile. When you are panic selling, you are letting emotion override strategy.
Yeah.
You are locking in permanent losses because you cannot handle the volatility drag.
Fourth is overtrading.
Constantly tinkering with your portfolio, trying to time the market, and racking up those trading costs and tax inefficiencies we discussed, which silently hollers out your compound growth.
And finally, switching strategies frequently.
Moving from value investing to growth investing, then to dividend chasing, then back to index funds, all depending on what worked best last year.
Always chasing the last winner.
Exactly. All of these mistakes share a common root. A profound lack of structure and discipline. You are trying to be brilliant instead of letting time be powerful.
That comes back to that quote again.
Right. Setting a structurally sound foundation and having the patience to see it through, resisting the urge to constantly intervene, is the true secret to building wealth.
So what does this all mean? We have looked at the mechanics of risk, the hidden costs of time and taxes, the devastating psychological traps, and the undeniable power of uninterrupted compounding.
You've covered a lot.
We really have. So how do you actually make a decision for your own portfolio today?
Well, the perspective provides a very practical, almost ruthless decision framework.
It does.
It asks you to answer 5 direct questions. And you have to answer honestly. Don't answer who you want to be, answer who you actually are.
That's the hard part. Question 1. Do you actually enjoy analyzing complex businesses? 2. Do you have the literal time in your week to monitor investments? 3. Can you genuinely tolerate large, sudden declines in your net worth?
Most people can't.
4. Are you emotionally disciplined when everyone around you is panicking? And 5. Do you want steady, predictable growth, or are you willing to risk it all for aggressive outperformance?
How you honestly answer those 5 questions dictates exactly which path you should take, and the categories are very clear.
Let's talk about the personas then. Who should choose index funds?
If you are a beginner, this is your starting line. But it's not just for beginners. If you are a busy professional, a doctor, a lawyer, an engineer, and you simply do not have the time to read 100-page financial statements, index funds are for you.
Right, because your time is better spent elsewhere.
Exactly. They are ideal for long-term retirement investors, individuals with small capital who need to guarantee their wealth builds steadily, and frankly, anyone who values simplicity and low stress in their financial life.
But to be clear, the perspective doesn't say individual stocks are inherently bad or evil. It just clarifies the massive barrier to entry.
Right.
Who should choose individual stocks? Experienced investors, people who actually know how and have the intense desire to read a 10K, analyze cash flow statements, and understand complex debt structures.
It's a skill set.
A very specific skill set. You have to be highly tolerant of volatility, and you must be a long-term conviction investor.
Meaning what?
Meaning, when your chosen stock drops 40% because of a macroeconomic panic, you have the deep research conviction to hold on to it, or even buy more, rather than capitulating and panic selling.
Now, for those who find themselves caught somewhere in the middle, perhaps you deeply value the mathematical stability and tax efficiency of an index fund, but you also have a bit of experience.
You want to dabble a little.
Right. You understand the market, and you want a touch of that growth potential. There is a very structured compromise. The document outlines what it calls a hybrid strategy, dividing your portfolio into a core and a satellite.
I absolutely love this concept because it addresses both the math and the psychology perfectly.
It really does.
It gives you a little bit of both worlds without risking your financial ruin. The hybrid strategy suggests keeping a massive core, 70 to 90% of your entire portfolio, strictly in broad index funds.
That core is your fortress. It guarantees your broad diversification, keeps your overall costs incredibly low, ensures tax efficiency, and secures your steady, uninterrupted long-term compounding.
It's the untouchable money.
It is the money you absolutely rely on for your future.
Exactly. Then you use the remaining 10 to 30% as a satellite portfolio. That is where you hold your individual stocks.
The play money.
Yeah, it is brilliant because it gives you a safe outlet for that psychological trap we talked about earlier. It lets you scratch the itch of stock picking.
You get the dopamine hit.
You get to do the research, feel the excitement, and try to find the next big winner. But it forces you to do it within a strict, disciplined structure that protects your long-term future.
It is intelligent risk allocation in practice. It balances the required stability of the broad market with the desire for growth. But, crucially, it mathematically caps your downside risk.
Because the core is safe.
Exactly. If you are wrong about an individual stock pick, if they suffer from a massive management mistake or total industry disruption and the stock goes to absolute zero, you have only lost a small controlled portion of your overall wealth.
It hurts, but it doesn't ruin you.
Right. Your core wealth engine, that 70 to 90% in index funds, remains completely intact, steadily compounding and continuing to recover with the broader market.
Which brings us to the final actionable advice detailed in this 40-plus year perspective. It is a very clear, unambiguous directive for anyone navigating this space. If you are unsure, Default to index funds.
Involved to the index.
Do not rush into individual stocks just because it seems exciting or because your friends are doing it or because you want to prove your intelligence to yourself. Start with the broad, boring basket.
Use that time wisely.
Yes, use that time to build your emotional discipline. Observe how you react to market dips and build your actual capital base.
The foundation has to come first. You need mass to create gravity. And then, only if you truly desire the extra work, allocate a controlled portion to individual stocks using that hybrid strategy.
Keep it controlled.
Wealth is not built by gambling on sudden, brilliant insights and hoping for the best. It is built through structure, patience, brutal consistency, and highly intelligent risk allocation.
Time is more powerful than brilliance. It really is the ultimate takeaway of this entire deep dive.
This raises an important question, though. We have spent this entire deep dive looking strictly at how these principles apply to your financial portfolio. We've analyzed how wealth building heavily favors discipline, structure, and patience over the immediate excitement and ego of individual stock picking.
Right, the idea of buying the whole haystack instead of exhausting yourself looking for the needle.
Exactly. But I want you to look at your own life right now, beyond just your money and your brokerage account. Where else in your daily life are you acting like an erratic stock picker?
Oh, that is a fascinating pivot.
Think about it. Where are you chasing the hype of a brand new fad diet, jumping from one shiny productivity hack to another, or relying on momentary, exhausting bursts of brilliance and motivation at your job?
Looking for the quick fix.
Are you constantly looking for the one stock pick that will fix your health or your career overnight? What if, instead, you applied a steady, compounding, index fund approach to your daily habits?
That puts a completely different spin on how we approach self-improvement.
If consistency, reduced emotional stress, and broad structures are the absolute best mathematical way to build immense financial wealth over 30 years, imagine how differently your career, your physical health, or your personal relationships would look if you stopped trying to pick the winning stock every single day.
Just focusing on the steady growth.
Trust the quiet, powerful compounding of consistent, unglamorous daily habits. Leave the ego at the door, let time do the heavy lifting, and watch how powerfully your life compounds.
That's it for today's episode of Wealth Hustle 247. Be sure to follow, like, comment, and share with others. Keep pushing toward your goals, and we'll see you in the next episode.